Hi everyone, and thanks for tuning in to another episode of Budget Investing. So today I'm going to go over how I'm investing to beat inflation and what are some tips and tricks that you can use to continue to make profits in these really weird times. All right, so first I want to understand that historical rate of inflation and how I'm going to use that to continue to invest to beat inflation in the long run. So obviously, if I look back the last 10 years or so, it's kind of hovered right around that 2%. And just recently, it's obviously skyrocketed up to just recently, just above 8%. Now, that's obviously extremely concerning as we are really starting to kind of spiral out of control, and inflation is causing the price of everything to increase, from our food to cars and everything else. Now, the government is going to try to really slow down that inflation rate as they want to bring it back closer to 2%. And one of the things that they're going to do is, of course, increased interest rates, which I spoke about in my previous video. And everyone is expecting at least a 50-point basis increase in June, which is obviously a large increase, and that'll jump us up to about 1.5% for the year, which obviously when we look back at the beginning of this year, we were sitting at basically 0%. So this is a pretty drastic increase to try to slow down inflation, as obviously it's affecting every aspect of the market and our day-to-day lives. Now, inflation and higher interest rates are definitely kind of tied together. As we get one, we tend to get the other. And with that, people's debt ends up costing them even more money. And it really starts to make that snowball and that downward pressure on stocks. And a perfect example of that is the Nasdaq. Now, as you can see with the Nasdaq, this is about roughly the last 20 years or so. With interest rates being so low and inflation being stable around that 2% mark, it's been that amazing opportunity for these companies to really push themselves forward and upwards. And it allows them to really take on a lot of debt so that they continue to innovate, make improvements, to drive growth and increase profits. And that's what you've seen over the last 10 years or so. But now that interest rates are increasing because of this ever-growing fear of the inflation, these companies that have been so driven towards leveraging themselves and having their profits be in the future are really starting to have investors be wary and scared of them. As you can see, Shopify here has been just dropping steadily. Like, they're down roughly 72% over really a very short period of time, since roughly November till now. And people are starting to take their money and place it into areas where they're going to feel a bit more stable, more secure. As I kind of mentioned, when interest rates go up, the debt's going to cost them more. So this is really going to start taking away from a company like Shopify and their profits. So it's really concerning for them right now. So how am I investing to beat inflation? I'm keeping it simple. I'm staying with my grassroots of investing in companies that have strong brands, that are basically monopolies, or products that don't represent a large portion of your budget, which allows you to continue buying the companies that I already hold. Now, no matter what you purchase in your day-to-day life, something that you can never get away from is going to be your groceries, as you obviously need that to survive. So holding companies like Kroger as an example will almost always kind of protect you during this time of inflation, as even though your fruits and vegetables might cost you more and you're going to curse Kroger for those prices that have increased, at the end of the day, you're going to go right back to Kroger and you're going to buy those fruits and vegetables and anything else that you need or want. So it's really just going to help Kroger out in the long run, as their profits are going to continue to rise as they increase the prices of everything, even though they might cost them a little bit more to get those items, but they're going to increase those prices and they're going to really just benefit in the long run. So why not hold them anyways and let them, pay you to shop there? Now, a few other examples are the sectors that I have on the screen here. So real estate, utilities, energy, and industrial, as these are the companies and the sectors that are going to continue to do well. As at the end of the day, you have to still pay your rent. So your REITs and your real estate are still going to be important, as you really can't avoid that. Utilities, you still got to pay those at the end of the month. So as their prices go up, you're going to make more money. And the same thing kind of happens with energy and industrial, as you're going to need to continue to maintain your roads and your power lines and everything like that. These companies are going to just continue to print cash, even though everything else is going to be more expensive. Another one which could kind of work in both directions here is something like an oil and gas company, specifically ones that are working with pipelines. If they already have the pipelines made, these are going to be money printing machines for you, simply because of all of their debt was priced in at that lower inflation point, especially if they've been able to pay it off already. But companies that are making huge investments now into new pipelines are going to be paying these higher rates with this increased inflation amount, and their debt rates are going to go way up so that their profits can't continue to follow along. Real estate is another prime example. Of if it's already paid off, it's just going to print money. But if you're buying new homes, you're going to be paying a way higher mortgage rate. So that kind of goes both ways depending on where they're at in that life cycle of purchasing and using right now. So again, to just reiterate how I'm investing to beat inflation, I'm going to be continuing to invest into companies that I know well as companies that really you have to keep buying, like your food and groceries, your utilities, and your home. Those prices are non-negotiable. You have to pay them no matter how much you get grumpy and mad at it. So I'm going to just continue to buy into those as their profits are going to go up. They're going to make me more money, and they're going to keep paying me those dividends, while I'm going to avoid companies that are taking on more debt. Things like technology and growth stocks right now, I'm going to kind of avoid. I'm not going to trim anything, but I'm just going to not add anything into those areas right now. But if you enjoyed today's video, thank you so much for watching. I do really appreciate it. Don't forget to like and subscribe, and I'll see you in that next video.